So welcome everyone to the FinGeo Semainr Series. This is, as you may know, the third of 6 in this tranche that Fenghua Pan and I are organizing. So next week or 2 weeks from now, we've got Sarah Hall of Nottingham presenting her work. And of course, this week we have Professor Michael Drew. We just figured out that we're actually only 2 kilometers from one another in different parts of Brisbane, where it's 10 p.m. So good morning, good evening, good afternoon to those of you all over the world. I see people from at least 3 or 4 continents, so that's always great, being a geographer. So I'd just like to first introduce Michael Drew. Professor Michael Drew is a professor of finance at Griffith University here in Brisbane, Australia. He's also a managing partner at MGD Private, and he also, as I said, works as a professor of finance at Griffith. He received his PhD in economics from the University of Queensland, is an accredited investment fiduciary analyst, and is a life member of FinCEA, the Financial Services Institute of Australia. He's a financial economist specializing in the areas of investment governance, pension plan design, and outcome-oriented investing, and he has been published in the leading practitioner journals. He's also been invited to make submissions and testify before numerous committees, including the SEC and the US Department of Labor. And my personal favorite role, and the most interesting role I think that Michael has, is as member of the advisory board to the Petroleum Fund of East Timor, which is our neighbor to the north here in Australia, sitting on a lot of oil money. So without further ado, I'll turn it over to Michael. Thank you. And if I could, sorry, just quick housekeeping. Keep your cameras on if you don't mind, just to give Michael a bit of an audience. Microphones off. We are recording, just FYI. And afterwards, just like we've been doing, there will be the opportunity to stick around and have some informal chats using the Wander app, which Duncan Lindo will be running today in Karen Lai's absence. All right, thanks, Michael.
Thanks so much, Thomas. Good evening all from Australia. We're very lucky in this country that we are essentially back to work, albeit with some restrictions, but we're thinking about our friends around the world at this difficult time. So I trust you and yours are safe and well. My role in the financial ecosystem is essentially as a steward of other people's money. So in my role, I govern the retirement savings of 700,000 Australians in their superannuation or pension plan, and that's about 115 billion Australian dollars. To the north, as Thomas said, I assist with a sovereign wealth fund, where, say, a 3 or 4% drawing from that sovereign wealth fund finances about 92% of the federal budget for the people of Timor-Leste. And finally, I steward the assets of the Sisters of Charity, all of their hospitals and aged care and schools around the country, which is about the 12th largest private company in Australia. So my role is sort of town and gown in that I'm a fiduciary, and I assist folks with the stewardship of essentially other people's money. So it's a great thrill to share with you this work that we've completed for the Chartered Financial Analysts Institute, their research foundation. And this evening, I want to share with you some of our findings and some of the things, I suppose, that are keeping us awake at night as we think about global capital market flows and how we as, say, financial geographers think about governance both in place and in time, and particularly the dynamism of investment governance is alive and well as we've had to steward a path through COVID-19. So this evening's presentation is on investment governance for fiduciaries. It's joint work with my dear colleague and business partner, Dr. Adam Wook. And we've had the great joy of being involved in this great investment governance role now for about 25 years. Disclaimers are important. I'll let you read that at your leisure. But regulatory views on the behaviour of fiduciaries, as you know, is an important topic, and we're alive and well to those risks. As I said, we had the great joy of working with Bud Hazlitt and Larry Siegel at the CFA Institute Research Foundation to put this monograph together. And a great service that the CFA Institute Research Foundation provides in raising standards around the world is that they provide these monographs free of charge. So some links are there and some op-eds that we've written and some press coverage. But if you just Google investment governance for fiduciaries, you can access all of that material, and we'll certainly put that on the socials as well, so you can access the information. Here's the challenge, and these are the things that keep us awake at night, literally, in this great investment governance role that many of us play. The first thing is around demography and increased life expectancy, and this sort of retirement savings gap between the amount we've saved and the longevity that seems to be increasing through time. And that mixed with the decrease or decline of defined benefit plans and the rise of defined contribution plans has really put a great stress on how we think about the promise of retirement security. In some parts of the world with common law jurisdictions, there are trustee and fiduciary duties that are sort of being made through courts through time. Other countries around the world have, like Australia, have very heavily codified duties for trustees and fiduciaries. So there's a really interesting movement around the world of best practice, the codification of that best practice, and how we think about putting the beneficiary at the heart of all we do. We are living through a time where we've had a pandemic, but markets around the world are now higher than they were pre the pandemic. So what's fascinating has seen, many markets around the world go through that volatility and drawdown in March, April of last year, and indices like the S&P 500 are up 70% from that max draw during that period. So a really interesting case study in how fiduciaries have mission clarity for those they serve and also role clarity. And we see under stress that those things can become confused and lead to very poor outcomes for investors. So forward looking, the best investment houses in the world are suggesting long-term low growth and a low return environment over the next decade, with cash and bonds, perhaps zero or negative real rates of return, and equities forecast to deliver sort of middle to high single-digit returns over that period. So a really muted outlook for capital market returns, which means for beneficiaries, how do we have that difficult conversation? We're seeing investors around the world push out the boat in terms of private market returns, the illiquidity premium, and looking for skill-based asset classes. So we in our work are challenging fiduciaries that as their asset allocation and their seeking of higher returns, the appetite for that has grown and grown. We've seen in many instances, investment governance arrangements lag behind the sophistication of the portfolio they hold today. Even within asset classes like bonds and fixed interest, private lending, credit, a whole range of quite skill-based asset classes are now commonplace. And we challenge fiduciaries to think about whether or not they've really designed and have a robust governance system to handle that increased complexity. COVID-19 has, of course, had terrible human impacts and differentiated impacts around the world, but it's also led to some stresses in terms of liquidity events. So we're thinking a lot about how fiduciaries can design portfolios to meet short and medium-term liquidity need with great certainty, but also participate in delivering real CPI plus returns for the performance seeking component of portfolios. So a very interesting dynamic there in how we think about geographies how we think about the role of geographies, both in terms of our domestic allocation and, of course, international allocation. We work, as many do, with families, and so philanthropy is very important, and how it's not just simply a function of investment risk, but a range of management of risks around reputation and impact and these sort of matters. So how do good fiduciaries deal with the new class of beneficiary investor that really is thinking through not just the investment return, but social, governance, environmental, and other types of impact returns? And how is that coordinated within the governance framework? There's the incredible thematic about the intergenerational transfer of wealth. And so now we're in situations where many families are both organising, planning, and executing that intergenerational transfer of wealth, and find themselves actually being a fiduciary to younger generations. So there's a really fascinating dynamic around the world. And again, depending on demographies of particular parts of the world, where we're seeing a great strain on the investment governance process as you steward money through the generations. There are many great scholars and practitioners on the call this evening who are leaders in ESG, socially responsible investing, impact, and decarbonising of the economy. How does a great fiduciary think through the process of not having climate change and responsible investing policy over there, but having ESG matters at the heart of the investment decision-making process? Simple to put on a PowerPoint slide, but how does one truly gain assurance as a fiduciary as to the consistency and the application of ESG, social responsible investing, impact investing principles, and the decarbonising of portfolios? A very, very important, on every committee I'm involved in, is in the top 3 issues regarding climate change and the expression of that climate change risk and the assurance around those risks throughout the portfolios of large asset owners. And as you know, as universal owners, with hundreds of billions of dollars in funds under management and securities around the world, these are things that absolutely keep the fiduciary awake at night. Finally, in terms of geography, a fascinating case study remains about, against O'Brien's sort of work about the provocations of the end of geography, we see incredible differentiation in portfolio designs, home bias, how global capital flows and the uneven surface of those flows around the world, and how large asset owners have to, I suppose, invest in a world as it is, not as the way in which perhaps the assumptions of neoclassical economics would like it to be. So how do we think through as a fiduciary, as a steward of money, these kind of list of issues and their differentiation around the world? So investment governance for us is essentially a story about the effective use of people, of policies, of processes and systems, usually by some sort of a governing body, a pension fund, a sovereign wealth fund, a charity, a foundation, seeking to fulfill a fiduciary duty to a principal in addressing an underlying investment challenge. And like most things in life, the challenge for the governance body is that alignment between the principal and their agent. And for those of you that are working in this field, you know that there are multiple chains of principal and agent relationships that go through the stewardship of money. So opacity, alignment, principal agent, moral hazard, all of the things that we understand about information asymmetry are part of how a good investment steward thinks about governing other people's money. So the debate continues, and the sheer weight of money, there are rising standards of behaviour around the world, as I said in my opening remarks, heightened regulation and activism. This is all coalescing and cresting around some of the pressures that we see in investment governance systems around the world. And of course, there is a human dimension to this story where if we just think, for example, of retirement saving and retirement income, we have a world where folks have worked decades and they reach their retirement date on a Friday. In this part of the world, they get a retirement card and a metaphorical gold watch, and then they have to transform their pool of retirement savings into a retirement income on the Monday. And of course, with interest rates around the world being so low and the retirement income hedging asset, which is usually inflation linkers or long-term corporate bonds, being zero or negative net real rate of return, we see these things occurring in markets: anxiety, stress, the costs of retirement, how to think through care in retirement, aging at home, aging in place, or aging in retirement care, and all of the things that COVID has shown around the vulnerabilities of those models. So in the debate about good practice regarding investment stewardship, we are seeing increasing number of lawsuits around the world, much higher penalties on fiduciaries. This fiduciary, remember, fiduciary comes from the Italian fiducia, trust. And so this special relationship of trust and confidence between the fiduciary or the trustee and their beneficiary. So penalties now are not just civil, but criminal, shredding of reputations, much tighter regulations around the world, greater scrutiny, and a greater debate around the world by the respective legal systems by geography. In this part of the world, we call them royal commissions or Senate inquiries or other kinds of hearings, which are looking into fiduciary practice and how the interests of beneficiaries are clearly at the heart of the investment process. So these are multidimensional, complex problems that are highly differentiated by geography. So where have we landed in this debate? After the global financial crisis, during COVID-19, we see the vulnerabilities and the fault lines, if you will, in the way investment governance systems operate around the world. Some organisations have taken a very negative response to this stress, where issues of, if I could say, career risk are prioritised, and letter of the law and minimum protections have been sought. So a really legal compliance-based response to the challenge. And I think the risk of this sort of approach is that, like many things in life, those fiduciaries that think of compliance this way are looking for the next checklist, the next ticker box that surely can take away our concerns about good practice and compliance. A very narrow perspective. The positive view looks at investment governance in something more strategic and is challenging organisations to ask not simply, are we doing things right, but are asking the next question, are we doing the right things? So a more positive approach has been to use investment governance as a strategic enabler and is typically around the development of and facilitation of risk management systems. As we undertook this research, and others in this field, Gordon Clark at Oxford and others, really have been part of a conversation that frames the challenge of investment governance by geography as a challenge of stewardship. So a sincere commitment to act in the best interest of the beneficiary, where stewardship is not simply directional governance, it's not simply risk management systems and compliance checklists and policy, but rather it's that side of the coin and the other side of the stewardship coin being relational governance, people, process, culture, what you walk past you accept, ensuring that issues of moral hazard and assurance are thinking through the people, human dimension of stewardship. So the best stewards of money around the world are developing systems that sort of look very seriously and coordinate two sides of one coin. Directional governance of policy and compliance and risk management, but then also are asking important questions about relational governance, people, culture, moral hazard. What do folks do when we're not looking? And how do we bring those domains together to meet the needs of those we serve? Now, financial markets, as you know, investment markets are very good at misadventure. And I think you only have to pick up the New York Times or the Financial Times, or any reputable business paper that you're reading at the moment, and there is currently, as there's always been, a complete fascination about capturing returns. Market returns at the moment are very strong. Returns have been outstanding. Everything is priced at the moment like it's going to work. And maybe there's a bit too much optimism and fascination in the fact that many investment markets see their role as capturing returns, and that's what good governance should focus on. Where we, I suppose, are assisting fiduciaries of other people's money, we're trying to broaden out simple framing that financial economics uses, like a Sharpe ratio or simply standard deviation or some measure of dispersion, as thinking about risk. And many investment committees get into these very standard financial economic type debates that surely we're here to minimize the standard deviation, maximize return, and that's our task. And I think we've seen post the global financial crisis and through COVID-19 that risk for fiduciaries today is not simply the second moment of the distribution, not simply a drawdown, not simply some left tail, conditional value at risk or some sort of tail type event. It's certainly part of the debate, but risks more broadly construed. Many of you this evening will be thinking about your defined benefit pension plan. You may be thinking about your defined contribution retirement plan, and issues of not just what is the Sharpe ratio or the return per unit of risk that the investor has achieved, but you're asking deeper questions. Am I on track to replace, say, 2/3 of my pre-retirement salary for life? So risk there is about falling short. Some of investors we work with are on foundations and charities. So they're not only worried about ensuring investment returns are sound, but risk for them is also about the probability of failing to meet a granting program, the failing to meet some sort of agreed financing of research, say an endowment into the future. And what about some of the open questions about the alignment between the mission of a foundation, say cancer research, and the portfolio that those investors hold? And when those two things are out of line, maybe environmental, social, and governance issues aren't prioritized in the investment corpus, but the returns on that corpus finance excellent work, we're seeing activism between those two domains. Vice chancellors with thousands of students outside their offices protesting the holdings and stranded assets within portfolios, as an example. So a very, very interesting debate about how do we think about outcomes and clearly defined outcomes for those we serve. And our work landed essentially on principles. So in each of the jurisdictions around the world this evening, you'll have the codification of duties, you'll have common law perhaps, statutory, all of those sorts of different legal requirements and hurdles and duties. But essentially, our work, I suppose, is thinking through what are those principles that are enduring regardless of geography. So the defensibility of decision making. Is the investment process repeatable? Is it documented? Is it auditable? Do we have clear investment beliefs that can minimize the risk of the large asset owner sort of drinking out of a fire hydrant, for want of a better expression? These things are really important in terms of the modern way of running money, of being nimble and making sure that investment decisions are both aligned and move the needle for the beneficiary. So we came up with a framework that essentially separates the strategic above the line, above the fiduciary line, and that, you know, our beneficiary is at the heart of this, of everything we do, and essentially differentiating clearly the strategic from the operational or implementation below the line. So starting at the apex where you have objective clarity, is it, and again in the monograph we talk through not just time-weighted returns, but also wealth-weighted returns. So being really clear about what are the investors' belief set? How does it inform their investment thesis? How does it inform their investment policy? And ensures that the investment process is well aligned and follows a cycle that aligns all parties around the beneficiary and defends the beneficiary. Then when you go below the line, what our research has found is that too many investors jump from policy to implementation. And as investors have sought greater returns and sought more risk, unfortunately, they at times haven't resourced the investment program correctly. So a common piece of work that we do with investors is thinking through, do you have a very small investment governance budget, which would typically lead to perhaps more passive, perhaps more smart beta style solutions. And then when we look under the hood, we see an incredibly complex, for example, private asset, alternatives, opacity, skill-based investments, where the governance function is not sized and scaled correctly to keep pace with the complexity of the portfolio that's been built for the investor. And that's where things break. So again, how do we protect the beneficiary at the heart of the process? And then with superintend, we've picked that word very consciously because many think, oh, well, we'll just monitor and review. Now, that's important, but that sounds like directional governance, compliance, where we think of superintend not just as investment compliance and performance monitoring, but culture, people, behaviour, alignment, those sorts of questions as well. So how does the beneficiary get assurance around not only investment performance, but behaviour, culture, reputational issues that align ultimately to that objective? Again, these things seem simple on a slide, a simple process, but there is misadventure abounds in the investment services sector and around the geographies of the world. Many instances where people governing the system above the line also provide services below the line. That's typically a very common area where conflicts arise. Our research also showed that in many instances, folks don't have clarity of investment beliefs or investment principles, which means the investment universe is as wide as the investor may like it to be. And this can lead to, if you will, the bowerbird problem, that every new investment idea, every new bright, shiny toy is very interesting to investment committees. So how do we ensure a constancy of belief, or investment beliefs, informing the investment objective, that informs policy in the investment thesis, that ensures that we have sized and scaled our governance requirements then to implement with our investment managers? And do we have the right systems that can superintend, monitor and review returns, but also allow the assurance to the beneficiary of things like culture, people, and behaviour? And then, are we on track to achieve that objective? So when we put this together, we came up with this idea of OPERIS, objective, policy, execute and resource, implement and superintend. And we used a trace Italian as our, if you will, our symbolic metaphor, if you will, of how we think about the fortification, where we see the investment governance process as defending the beneficiary, and that great fiduciaries understand that this defence is only as strong as its weakest link. So how do we ensure we are constantly defending, checking, gaining assurance for those that we are here to protect and serve, our beneficiary? And we've got a little quote from the Gallic Wars by Julius Caesar, and there's a quote in there about operis mutione, which is the works of defence. And that's where we took our inspiration for operis. When we use the word defence, we're not talking about bonds and cash and defensive assets. Rather, we're talking about a constancy of process, a defensible process, a repeatable process that puts the beneficiary at the heart of all we do. So here's the challenge. Here's the things that our work, I suppose, led us to sort of call out. And again, really keen to get your perspectives on the different geographical takes around the world on these issues. So we see defensive, as I said, as defending the beneficiary from risk events and or uncompensated risks. So for instance, during the COVID drawdown in March, April last year, the great investment processes don't capitulate, aren't a forced seller in down markets. So do we have good investment design that we're governing that allows us to meet the need, say it's a granting program or retirement income, and do we use the best of behavioural finance to think through how we then ride out volatility in a performance-seeking way? So how can we use behavioural finance and nudge to get great outcomes for our investors? It has to be continuous, that all of the investment committees I'm on and the great investment committees I've worked with leave that meeting each month or each quarter feeling like there is something more to do. And that is actually how it should feel. And we've been working with a range of boards on the professionalisation of their investment governance arrangements. And this has come through so strongly in this work. It never feels quite finished, Michael. That's exactly how it should feel. It's never quite finished. There is more to be done. And those funds that end up in court cases and litigation typically have the most beautifully drafted investment policies and investment governance frameworks, but they sit in a filing cabinet or they sit on a shelf, and they are really only geared to directional governance. So they have to be living documents. The fiduciary line is important in that it separates the governance or the strategic from the implementation. And I can't tell you during this work how many examples we continue to find where that line is blurred and the actors all of a sudden are wearing multiple hats across the investment process. And it's that multiple hat problem under stress that typically is the first thing to unravel when there's a problem. And we would hate for you to think that this is some end-step formula. Rather, what we're trying to do with this work is share with colleagues around the world that it's principle-based, it can be designed for a family office, a foundation, a pension fund, a granting program, a sovereign wealth fund, but the principles are pretty enduring about role clarity, mission clarity, and separating those in governance roles from those in the implementation role. So a bit of context, and just a couple more minutes, if you don't mind, Thomas, and I'll come to a conclusion. So what's the nature of the investment challenge? So for instance, in one of my roles at QSuper, we're a defined contribution plan, retirement plan for, say, 700,000 folks and 115 billion in retirement savings. We need to be very clear that we have folks there that are in the first weeks and months of their first job, in their early 20s, all the way through to folks in their 90s and beyond. So how do we ensure that we have real clarity around the investment challenge our beneficiary is facing? Is the organisational context fit for purpose? Is it our core business, or is it an adjunct to our core business? And the reason we raise this is that when we looked at the geography of large asset owners, that there's sort of very different governance arrangements and very different investment challenges that they all face. So the organisational context, that great geographical debate about routines, unfit or fit routines, where those routines come from, the geographical context of those routines is very important in this work. The third box is governance budget, and very many investors, many investors understand things like what they pay active managers, say, or what they pay on their infrastructure program or their private equity program. But we challenge fiduciaries not just to think about governance budget as fees paid to investment managers, but do we have the right people, processes, systems and resources to govern the complexity of the underlying investments within the portfolio? There is just incredible opacity in this business. And we see at the moment that in a low return, a low expected return world, many investors are pushing out the boat in terms of their investment risk, but don't have commensurate resources to govern that higher complexity and higher risk with the same level of robustness. So that's really assurance. Does the fiduciary gain assurance over the investment program? And under stress, we've been talking about this, who decides what and who does what. And to protect the innocents, I'll share with you a little story that during the global financial crisis, there was more than one investment committee meeting where the chief investment officer or the chair of the governing body would say, who's responsible for this? And executives would go like that. And that's when you know the governance process is broken, under stress. So we need to do this and keep testing, scenario and stress testing our process. So a couple of final slides. So we think of metaphorically the journey where the passenger, if you will, is our beneficiary. We need to have destination clarity. Airlines are very good at this. You get on a plane to New York. You don't typically end up in Boston or Miami. You tend to land in New York. And in financial services, it's important that we also have clarity of destination. And do we have the right aircraft? Do we have the right investment vehicle? And I'd suggest to you this evening that under stress, we've seen during COVID-19, the complexity of investment programs get heavily under stress and the accompanying governance structure lagging behind. How do we think about our crew? Do we internalize the investment process? Is it outsourced? Who is aligned and who is representing our interests? Simple to put on a PowerPoint slide, but the misadventure of investment markets is alive and well. Charting that journey and operating the plane and adjusting to conditions is a very important role for the trustee or the fiduciary. So really, again, stressing this idea, a dynamism, a process, and again, something that is repeatable, auditable, and can give the beneficiary a clarity about the rationale for decisions being made. So finally this evening, just our key arguments. There's an important distinction in our work between investment governance expertise and investment expertise. A subtle but important nuance that in many instances around the world, fiduciaries are actually accidental fiduciaries. They have these roles because they are a senior industry leader, a CEO, a CFO, they're academics on the university pension plan, they're a cancer oncologist specialist who's on a cancer foundation. There are times where the steward of money don't naturally have investment training and investment expertise. So this is why we wanted to share this work on good process and ensuring folks are armed to ask the right questions at the right time. So finally, some points of reflection and then just framing the work. So challenges around, can I succinctly summarize the investment problem I face? And that's for everybody on the call this evening, your family, your pension fund, the charities and philanthropy that you support, real clarity around those issues. Have you thought about how agency risk applies to your situation? And as I said, once you scratch this, you see that there are actually multiple principal and agent chains through the process. Have we framed what a best practice steward is? And there are incredible learnings from great stewards around the world. And the other one that might be strange this evening to share with you is, what does success look like? There is a real problem in investment governance that when investors achieve the objective, there's this little thing in their back of their mind that they like a little bit more. I've achieved the objective, but I just like a little bit more. And that's a very important, but can lead to a vast array of risks where the objective has changed and people are suddenly seeking a little more than the investment complex can handle. So this is a really interesting behavioural discussion about what is the risk you require to take, what is the tolerance of the risk that you can take, and importantly, what's the capacity of risk? How much risk can you actually afford to take? And these are three subtle domains that, as you can imagine, under stress, can fluctuate dramatically. So clear thinking, clear objectives, and a clear risk appetite statement from the investor. So finally, this just gives you a walkthrough of the work, beliefs and objectives, portfolio construction and investment policy, implementation of the investment program, and as I mentioned in the book, how do we superintend these roles and responsibilities and monitor and review. A little bit about us. Thomas, thank you again to you and the leaders of the FinGeo network. I really do appreciate the invitation. Thank you.
Great. Well, thank you so much, Michael. That was fantastic. If we could all give Michael a round of applause. So we'll open it up for questions. We've got about 15 minutes, and we've got two in the chat that I'll kick off with. So from Rolf, we've got a question about what kinds of forces are behind the development of tighter regulations. Do these forces help better international management ethics worldwide?
Great question. Thank you very much. Yeah, so certainly from what we're seeing, there is a great, let's use environmental, social, and governance and climate change investing as a current example. It's been fascinating to see the development for large asset owners of something that was over there, something that many pension funds might have as an option, to now these matters being at the heart of the investment decision-making process. So we see the great fiduciaries and the large asset owners around the world having ESG, climate change, the Paris targets, and these issues around a process that's repeatable and auditable and measured and captured as being standard analytics now coming up to investment committees. So for us in this part of the world, debates around stranded assets, many of you know the basis of the Australian economy. These are really important questions that are some of the forces that are driving the development of tighter regulations. Issues around stranded assets are really topical for us in this part of the world. So, and in actual fact, how we think through transition and mitigation strategies and how we price those is also part of those forces. We're also really doing a lot of work in terms of slavery and these sorts of questions, modern slavery, human trafficking. So for us, again, large asset owners coming together and dealing head on with these things which we can't ignore, Thomas. I mean, a large asset owner will own 6,000, 7,000, 8,000 securities. They're invested in every asset class in the world. They have exposures to all the geographies and all that brings with it. And I suppose for us, this sort of universal ownership thematic is really leading us to look through our supply chains, look through our investment managers, and really challenging the ethics of how we deploy capital. I thank you very much for your question. We could do a whole seminar on that topic.
So that actually, I think the two other questions are very related to that. So I'll sort of combine them because they're very similar. Michael's is, what part of the ESG captures the most attention of your clients, and whether the clients are interested in the S. And then maybe after that I'll ask Martin's question.
Yeah, thank you, Michael. That is I feel I'm going to win the Nobel Prize if I can answer that completely. That's such a great question. Yeah, I think you know what I'm about to say. The large asset owners that I'm involved in are sound on G. Governance and our voting and proxies and that process is very well developed. E is getting far better. And interestingly, just to share a case study with you, we at QSuper, when we've developed our ESG and climate change policy, we wanted the E and the S of the G, but let's just focus on E and S for a moment. We asked the team, the investment team, not to just go and do another study on listed equities, if I could put it that way. Many asset owners start, and that's fine, that there's a lot of great work on public equities. But we asked the team to go and look at E and S and G, but E and S with our private assets. And this to me was a really fascinating challenge for the team, that we are still developing, investing, as many large asset owners are around the world, in improving analytics around E, but we are working day and night to further advance the S. So we find with our members that the greatest, and we survey our members regularly on these sort of components within our climate change policy, and S, the sustainability question, is the one we get incredible engagement on, incredible diversity of views, to be honest with you, Michael. And so there's a really interesting fiduciary challenge there about how large asset owners develop capability and can use the same methodologies and seek the same assurance around S. Again, I apologise that's not a fulsome answer, but I did want to share with you some data that we've got from our members from the field, and the fact that I think we have to be quite humble as large asset owners, that there's much more to be done across all of those domains, but S is one that our members are very, very interested in, that have the widest views on, and we are constantly striving to go back to that sort of repeatable, documented, measured, and seek the assurance around our activities in capital allocation as it relates to sustainability. If you've got it solved, Michael, please send me an email.
Great. Why don't we go to Martin's? Martin, do you want to ask your question since it's strongly related?
Yeah, fine. Thanks, Thomas. Hi, Michael.
Hi, Martin.
Thanks for a fascinating presentation. It's just so brilliant to hear the insights from people who are working directly in the field from a practitioner like yourself. It's fantastic. Now, I have a very simple question. Like,
I don't think it'll be simple, but yeah, okay.
Actually, from kind of my kind of naive perspective, I suppose the big challenge with investing is, of course, this kind of a potential conflict between financial returns and profitability of investments and what that investment may potentially do in terms of, say, accelerating climate change or causing social injustice or increasing inequality or what have you. And so you mentioned these tensions in your presentation, but I'm interested to know, I'm fascinated to know, how do you resolve these when you are confronted with something like this? Like, what do you do? Like, what wins in the end? Like, what kind of makes the final decision? And then related to that, of course, like, what happens when you and your clients, your investors disagree on, what should you do? So what if the client wants to invest in some fossil fuel industry, which you would, can say that you don't advise because of both kind of potential financial disastrous returns, but also because of environmental impacts, but your client insists on this. So who kind of makes the final decision? So 2 questions there for you. Thank you.
Yeah, I'm looking forward to the hard question, Martin, if that's the simple question. So that's great. It's a great question. The number one thing for the way we think about it in this research and the way we think about it with clients is actually to start with investment beliefs and investment principles. So Martin, I know that seems a little old-fashioned, but investment beliefs for us are, if you will, the metaphorical North Star. That once you're clear on your beliefs, it informs your investment thesis, it then aligns your investment policy, and it then guides how you, for want of a better expression, harvest returns through the different asset classes and then aligning that to the objective. Now, I wanted to start there because, as you could imagine, particularly in the last question relating to S, we can get most people on the page with E and G, but I don't know, I'm interested, if you just nod, but S for us is the big dance. And some of you are nodding that this is a great challenge. So we Martin, are doing a couple of things to think through this. We've created governance processes that are not just only thinking about sustainability and environment and governance today as it sits, but radar and early warning systems and capability being built on the next 10 key issues that we see coming over the next sort of 2, 3, 4, and 5 years. And then, Martin, we use the science. To be honest with you, we source experts from around the planet that can help guide us and raise our capability and raise our investment process and challenge that process to engage with these types of issues. So that's at one level, those beliefs. And so, for instance, we've got some families, for instance, who are very strong on matters of climate, on matters of human trafficking, and for instance, with some of our wonderful sisters, they've got some very strong faith-based investment screens, if I could put it that way. So I think we have to work very closely to respect the beliefs, priorities, and screens. And I mean that positive and negative. I don't just mean negative screen, that the client. But Martin, to be honest with you, we then work on all of the analytics around those particular issues. So for us, we are so concerned, as many of you are in this call, about greenwashing, brown spinning, whatever you want to call it. So for us, good beliefs, good process, the analytics, evidenced in portfolios, monitored and reviewed on the way out. We've helped folks with, say, social benefit bond programs where the vast majority of the return has come from some impact and social good. So we've had to model right down into things like truancy, recidivism, whatever the issue might be, and that's been the priority within the investment program. Now, to answer your question directly about how do you deal with conflict, we have found that if you don't have that framework and review it, challenge and seek assurance around it, that's where the conflict typically arises, where there is some confusion or lack of clarity within the investment program that is constantly throwing up investment ideas which don't align with the environmental, social and governance framework set in the policy. And so there's always that grey area where, do we invest in the pipeline infrastructure, but the pipeline is shipping, whatever it might be, oil or fuels or whatever it might be. So what we tend to do, Martin, in that regard is build capability in core areas. And what we also do is to assist the fiduciaries, work with experts that can scenario and stress test the Paris Accord, all of those modelled scenarios, and bring that down to the portfolio level and provide the fiduciaries with a decision-making framework that allows them to think about, are we on track? Have we committed to the 2030 target? How can we provide an evidentiary basis around that? If the opportunity cost decision, if we're unsure, how would this then work within that set of scenarios? So Martin, I think your question, again, it's a cracking question, and there are, fantastic resources and innovation. We've seen work being done on like a climate change CBAR, really, cutting edge climate and cutting edge finance scenario and stress tested with the tails of the distribution, really fantastic work being done. But I think it does come back to, we have a saying in Australia, if you're not a lawyer, you're a bush lawyer. So don't take what I'm about to say as legal advice, but rather a story. And the bush lawyer in me says something like this: you don't typically go to jail for making a bad investment decision. You typically go to jail for not having a process. So how can we work with our beneficiaries, align our beneficiaries' interests to the fiduciary role? The fiduciary is the gatekeeper ultimately of that capital. It sets the rules, it sets the policy, it must seek assurance from the investment process, and then superintend that on the way out.
Hey, sorry to cut you off. We've got 1 minute and we've got one more question. So I'll just really quickly, if you could give us sort of a 20-second answer to how QE and the qualitative shift in central bank holdings since the crisis has changed the financial landscape for pension funds.
Yeah, it's a great question, Duncan. Thank you. Really cracking question. So printers go around the world, money printing, money printing, money printing, cash rate zero. And what we're seeing is things such as QE and financial repression are sizing and scaling the risk in ways that we've never imagined for many generations. So retiring on Friday, if you're fortunate enough with $1 million in the bank, and in this country, you can't replace the public pension with a term deposit or a very low risk investment with that amount of capital. And most people with $1 million think they're going to retire comfortably because they're millionaires, yeah? And so we're about to have a very difficult conversation with this generation. You're going to have to eat capital. And with interest rates coming down, that huge structural decline, and compression in interest rates. Growth asset valuations have done that, which means we might have brought forward 10 or 15 years of returns into today. And that's going to be a very difficult conversation for the baby boomers and those generations around the world that are seeking a stable retirement income stream.
Thank you, Michael. I have a feeling we could probably go on for about another hour with questions, given the interesting nods from everyone. But unfortunately, we're out of time. So if everyone could just give Michael a quick virtual round of applause. Thank you so much. Duncan has posted the Wander link into the chat box, and I'll just post it again. So if you would like to kick around and have a chat, feel free to click on over, and Duncan will be moderating that. Otherwise, thanks again, Michael. Thanks to all of you for tuning in, and we'll see you in 2 weeks' time for Sarah Hall's lecture.